afternoon, or good morning, depending upon your time zone. My name is Doug Deitch, and I'm a principal with Keystone Risk Partners. With me today is John Naughton, also a principal for Keystone Risk Partners. And thank you for joining us as we discuss our approach to 831B captives. From the look of the list of folks on our call today, we appreciate those familiar with Keystone, and we welcome some new folks to the fold. We look forward to working with all of you. So before we begin, some housekeeping items. You should have received a copy of our webinar prior to today, and if not, simply type your name and email address into the question box, and we'll send one right over to you. Also, should you have a question during the presentation, type them in again using the webinar toolbar. The content portion of our presentation will be approximately 35 minutes, followed by an ample question and answer time. But before we begin, some history. Under the heading, History Repeats Itself, and that's one of the things that's wrong with history. There's probably a few of you on the line that remember PORCs, producer-owned reinsurance companies. This was the early ancestor of the 831B, referred to as a 501c15 insurance company. Premiums for this insurance company, if we're under 500 or 600,000, were completely deferred of all income taxes. A nice structure for a legitimate insurance transaction. Unfortunately, this structure was abused by financial planners who convinced business owners to provide significant or stuffing of capital into these captives to support very little premium. The result of that effect was a huge deferral of investment income, which got on the radar screens of the folks at the IRS. The result, in December of 2003, Congress changed the rules, creating a $600,000 maximum on earnings in a captive, as well as a captive owner if they are in the same controlled group within this 501c15 arrangement, toppling the tax play and officially eliminating the 501c15 from the risk management toolbox. So that brings us to today. There's a lot of buzz in our marketplace for 831Bs. Too many webinars from CPAs, tax attorneys, financial planners, and consultants to count. So how does Keystone's approach differ? Well, first, our agents and brokers are primary in the delivery of this concept because we really want to solidify the risk management purpose. Keystone then becomes the technician, providing the underwriting, regulatory, strategic, and coordination with the insured's tax advisors, all built on this firm foundation of an insurance purpose. While tax advantages are significant, they cannot be the focal point of the 831B solution. For those intimately familiar with our Keystone Risk Partners story, just indulge me for a minute as I refresh you as well as provide information to the rest of our group. We work with agents and brokers to deliver alternative products and solutions for your insureds that are willing to assume a portion of their own risk. Through the formation of Sunstone Assurance LLC, our Delaware rent-a-captive facility, we have simplified the build-out of our most popular captive products that include large deductible alternatives for primary casualty, work comp, auto, GL, minimum large deductibles of $100,000, and for qualified structures, a tax-efficient financing of large deductible obligations without the use of letters of credit. Direct captive policies that are customized for uninsured and underinsured exposures. We have a case study for this later in our presentation today. Fronting arrangements for state and vendor requirements of highly rated insurance, and parallel deductible reimbursement plans for insureds that are already on a large deductible or a high self-insured retention. And finally, a transitional deductible plan, which is for insureds that are not completely ready for a captive, willing to dig in deeper to some of the mechanics and value, but not ready to move right away. We build essentially a warehouse for them where they're in a loss-sensitive approach, but with our carrier partners there is a transition plan to move them into a captive when they are ready. So with the exception of our transitional large deductible product, all of these other arrangements have a captive touch, which allows for an 831B election within any of these products. And as an FYI, throughout the balance of this year, we plan a series of subsequent webinars to dig deeper into these product applications for your agency. But now back to the agenda for today. Over the balance of our time, we plan to dig into the foundation for building a solid 831B structure, touch on the must-haves and common pitfalls, and conclude with a case study to review the next steps. Our goal at the end of the session is for you to walk away with a deeper understanding of the value of this concept and the ability for you to effectively deliver this unique product to the most appropriate clients or prospects. So at this stage, what I'd like to do is to turn it over to my partner, John Naughton.
Thanks, Doug. Over 450 of the Fortune 500 companies have captives, and until recently, the general rule of thumb was that the larger the company, the more likely a captive might make sense. That remains the rule with one powerful exception, and that's this 831B election. Though it's been around for some time, it seems like as recently as 5 years ago, no one had ever heard of the 831B election, and now it's everywhere. Where did it come from? As Doug mentioned, primarily CPAs, tax attorneys, and financial advisors. The brokerage community is really just catching up. So what is this election? Well, the 831B does not refer to a specific captive structure, rent-a-captive, single-parent, group captive, but rather a section of the tax code that was introduced as part of the Tax Reform Act of 1986. It was originally put in place to incentivize the formation of new niche insurance companies such as crop insurers, petroleum insurance companies, etc. So this is what the section of the 831B tax code says. If an insurance company, of which, as we'll get into through the remainder of this presentation, a properly structured captive is an insurance company, but if an insurance company writes up to but no more than $1.2 million of annual premium, that insurance company enjoys two significant financial benefits. The first, any underwriting profit that's realized in that 831B captive is not subject to taxation. The result is deferral or unlimited deferral of underwriting profit. Second, once distributions are eventually taken from an 831B captive structure, those distributions are treated as a qualified dividend, so currently 15% tax rate as opposed to ordinary income with other captive structures. Weaving in a bit of wealth transfer and estate planning early on, distributions are not subject to gift tax. So currently dollars that are moving downstream from one generation to the next and taking on a up to 50% tax load. A cottage industry seems to have sprung up around these structures, and again, it seems like they are staffed with CPAs, tax attorneys, financial planners, etc. In fact, these 831B structures are generically termed wealth or micro captives. It's as if the ideal candidate pitch goes something like this. CPA walks into his privately held customer's office sometime around the 1st of October and states, "Billy, we have a problem. We're making too much money again. How about an 831B captive?" Well, how about approaching it a little bit differently? How about approaching this from a risk management standpoint and building from there? Pretty novel concept. So let's start with the insurance purpose. Most businesses have a number of risks that they elect not to purchase traditional insurance for. Two primary reasons. The first is the coverage that they're looking to purchase is unavailable, or if it is available, the coverage that they're looking to buy is unaffordable. So the risk management decision is, it's a risk I have and I'm willing to assume on my balance sheet. Well, the solution here is an 831B election made by a captive. And in this instance, the captive that we use for most of our 831B structures is Sunstone. Sunstone is a Delaware Series LLC captive. Generically, you may have heard the term rent-a-captive. What Sunstone's means for you and your customers and prospects is a much lower capitalization requirement and much lower frictional expense in terms of entry and exit. Policies and coverages are individually manuscripted for each customer inside of Sunstone. Your customer retains any of the underwriting profit and unlocks the value previously mentioned of this 831B captive. And if one of those previously uninsured claims actually happens, your customer will now be ready to deal with it. Now, the election is not class of business specific. Every business has uninsured or underinsured exposures that they deal with on a daily basis. Just a sample of some of those types of businesses that we deal with here: healthcare companies that deal with pandemic exposures, MRSA infections and administrative fines, agricultural type operations that have spoilage and animal mortality or OSHA issues that they have to deal with, contractors with mold, pollution, construction defect, and your manufacturing operations that may deal with product recall, litigation defense, or wage and hour, which seems to be a hot topic that we're spending a great deal of time on these days. Is it an exposure if there's never been a claim paid? The answer is for sure. And in that instance, typically a percentage of revenue, payroll, or some other exposure base is used to actuarially arrive at insurance premiums to fund this 831B captive. So now that we've handled the underwriting purpose, let's look at this a bit more strategically. And from both an underwriting as well as a strategy standpoint, this is where you, the broker, are playing a very active role. So inside of the office of the CFO, from a cash flow standpoint, the CFO now has the ability to manuscript cash flow into an 831B captive, understanding that that annual cap is $1.2 million. But what that manuscripting does, it allows that CFO to budget for exposures and minimize cash flow volatility when those unexpected or uninsured losses actually do occur. As part of the 831B captive setup, assuming that there will be a claim or claims paid from the structure, decisions are made involving who's going to handle claims. Typically, we work with unbundled third-party administrators to handle claims. And then lastly, what do we do with the dollars that are now sitting inside of this 831B captive structure? Well, one typical use for those funds is to provide alternative sources for letters of credit to large deductible insurance carriers. After all, a lot of our 831B customers aren't just funding these uninsured or underinsured exposures. They may be on a $250,000 deductible for their workers' compensation. And there's a fronting insurance company sitting there somewhere saying, I need a letter of credit from that business. Well, what if that business can eliminate that letter of credit from their books and put that LOC on the books of the captive? Because these are separate assets inside the captive, they provide protection against creditors. And when the owner begins to walk in the room, we begin to introduce the concept of unique ownership possibilities in who actually will gain access to underwriting profit and investment income in an 831B captive. There are a variety of different applications in terms of who can actually own profit. Some of the examples that we see most common include shareholders of the corporation that's setting up the captive structure, family members of the owners of the business setting up the captive, key employee retirement accounts that include both owners as well as potentially CFOs, risk managers, and safety personnel, and then third-party estate planning trusts or other wealth transfer mechanisms. So let's walk through the tax benefits with just a basic financial structure. On the left-hand side, we've got a situation where we have a business that has self-insured exposures. They do nothing about them. and their business ends the year with pre-tax income of $1.2 million. Well, if that $1.2 million, conservatively, there's going to be a tax expense of 35% or $420,000, which leaves cash at the insured level of $780,000. Well, what if we set up an 831B captive structure and turn that $1.2 million of pre-tax income into captive insurance premium? In that instance, we have a broker risk management fee for the value that you're providing in the structure of $20,000 in this example, a captive management all-inclusive expense of $65,000 in this example, and now cash at the captive of $1,115,000. Assuming the captive is simply an extension of the business's financial statement, we now have annual additional assets to handle these uninsured claims of $335,000. Now, back to the risk management fee here. There's three typical ways in which we tend to see our broker partners generating income. The first is, as I've laid out here, a risk management fee inside the deal for the role that you are playing in setting up and in the ongoing work that's done to maintain this captive insurance company. The second example would be a fee outside the program, either in addition to a risk management overall fee that you're providing on the account or a new outside fee that's generated. Or lastly, a broker of record that you now are involved with on the primary insurance placement in exchange for the value that you've provided to that prospect by bringing this new 831B insurance mechanism. Now, only in the insurance business do we force businesses to think in 12-month increments. This is a long-term strategic approach to risk, and as such, the long-term benefits are significant. And to reiterate in this example, the difference after 5 years of doing nothing versus the 831B captive is $1,675,000. This is tax-deferred growth that's taking place inside the captive. So we've woven in the simple tax benefit. Now let's just share one additional estate planning tool that's available with this structure. And for privately held, tightly held businesses that have an estate planning trust in place, there's another significant tax advantage that can be achieved using this 831B structure. If the trust owns the captive, distributions from an insurance company are not subject to the estate tax. So this may have been slide 1, 2, or 3 had we been leading with tax. It absolutely is part of the overall philosophy behind 831B captives, because once profit is realized in the insurance company, there are some significant taxation benefits on the back end. Now, must-haves. I mean, this is a very powerful election, this 831B structure, but not every prospect is a good candidate for this structure. The must-haves in terms of the new business selling that you're doing for 831Bs or in explaining it to existing customers, number one is it has to be a business with solid financials. It has to be a business that continually generates net income inside the business, because if that business isn't generating profit and taking tax, premium deductibility means nothing to them. And number two, they have to have access to cash. This might all sound real good for a business, but if they can't fund the 831B structure annually with cash, at the overall point of sale, they'll decide that it's best to just hold off for now. This selling cycle always includes a collaborative effort with the owner or the CFO. As we've described throughout, the CFO likes the cash flow flexibility, the alternative sources of letter of credit, etc. That owner might be very interested in some of the wealth transfer and estate planning benefits, so our discussions oftentimes include both of those. Businesses who are alternative thinkers that are willing to look at risk differently than the way they've looked at risk in the past, and because this is not a one-year plan, businesses that are long-term strategic planners. Some of the common pitfalls that we've seen in looking under the hood of other 831B structures fall into two general categories. The first being that there's no substance to the structure. The general sniff test just isn't being met, and we see that come into place in a few ways. The first is risks that are being funded into the captive are unrelated to the business. The light manufacturer that's trying to fund animal mortality exposures into a captive just doesn't seem to make sense. Number two, no potential for insurance claims. I mean, an insurance company pays claims, and this 831B captive is an insurance company. So insurance companies that don't pay claims tend to have a spotlight focused on them. Number three, no structure in place to handle claims. That's an extension of the second. If there is no TPA or claims handler chosen, we're certainly not ever expecting to have a claim. And then lastly, structures that are missing the non-tax business purpose, that have the strategic plan in mind, that have the risk management plan in mind. Number two, no risk distribution. Risk distribution, for those of you who aren't familiar, is one of the tests that the IRS over the years through a series of revenue rulings has spoken to regarding a business whose captive qualifies as insurance for tax purposes. Risk distribution is the IRS's way of looking at a captive and saying that that captive is structured in such a way that there is risk sharing taking place. Captives will typically achieve that in one of a few different ways. The most common is to actually have a business qualify for risk distribution through their own organizational chart. We see captives that try to meet that test, but they simply lack the necessary subsidiaries to meet the IRS revenue rulings. Another very common way to meet the risk distribution test is to go out and find third-party risk, a general contractor that goes out and finds subcontractors to join their captive. Well, many that try simply lack third-party risk inside their captives. And lastly, the utilization of structured risk pools, where independent captives who are failing the risk distribution test come together inside of a risk pool in order to meet the IRS safe harbors. Well, if a risk pool is set up and that risk pool has a 0% loss ratio, question that should be asked is, was there any real risk sharing going on inside that risk pool? Terrorism risk pools, which we've seen in the marketplace, are probably pretty good examples of where we dig a little deeper to find out what is really the expected loss inside of those pools. So finishing off this section, is the 831B captive structure too good to be true? Well, absolutely not. And in fact, there's three ways in which we primarily use the 831B election. The first is for insureds who are on or moving towards a loss-sensitive casualty program. So a customer or prospect of yours that's on a $250,000 deductible with you named the insurance company, annual expected losses of $1 million, as opposed to swapping letters of credit without the ability to deduct that $1 million in expected losses until it turns into paid claims. We set up a 831B captive structure using a deductible reimbursement policy and provide that business with the ability to unlock the values of the 831B election for their casualty expected losses. The second would be what we've just spent a fair amount of time talking about, the business with unique uninsured or underinsured exposures that cannot be efficiently solved through traditional sources. We simply use a direct policy out of the captive and manuscript those coverages accordingly. And lastly, a combination of 1 and 2 above. So a business that's on a large deductible for workers' compensation with a $500,000 expected loss and another $500,000 of uninsured or underinsured exposures, the combination plan. The bottom line, these are bona fide exposures with less than $1.2 million of annual expected losses. With that, I'm going to turn it back over to Doug to walk through a case study.
Thanks, John. And to wrap up this presentation, we want to use a case study to ground some of the concepts that John just went through in building the foundation for a solid 831B captive. As far as the case study is concerned, the format is fairly straightforward. We're going to talk about the assumptions and challenges of the case, the structure of the 831B captive solution, and the financial benefits and goals that were achieved. So this is an uninsured, underinsured exposure that keeps the insured's owner, CFO, up at night. And the cover is litigation defense, a coverage, an exposure that is currently self-insured by the business, who simply pays the losses, pays the expense for the litigation out of operating income at the time the loss hits. The challenge is the legal defense expenses arising from incidents that occur with this business and do not result in a covered claim under their GL or professional liability can be substantial. And they're infrequent. So that from a budget perspective, the unpredictability of when that lawsuit will hit, how much the defense cost would be, has impacted this business historically, and they're looking for an insurance solution. The reality is there's no affordable traditional insurance solution for litigation expenses. Our solution would be to establish a captive with an 831B election. We can use one of our customized direct policies from the captive to insure this risk, and the result would be a very tax-efficient way to build up reserves for this uninsured yet inevitable exposure for the business. Some key facts about the case. This is a business that's historically profitable. An average pre-tax income of $2 million or more with excellent cash flow. It's also a family business that's open to unique solutions. They can't find them traditionally, and they're willing to look outside the box. And the owner itself is very keen on wealth transfer tools. They've maximized their current resources for estate planning. They're always open to ideas on others. So some types of businesses that might fit this mold for this kind of solution would be architects and engineers, manufacturers with heavy product exposures, service industry, providers of outsourced specialized resources to clients with heavy E&O exposures. This particular business, when it thought through potential solutions, realized it didn't really want to form and run a captive, but it wanted to have some of the same benefits of having their own captive. So the solution that we came up with was a turnkey one using Sunstone and making an 831B election. Some of the insurance specifics about this case, the loss and exposure data, which we got at least 6 years of information on, actuarially supported about $1 million of the annual premium. The annual estimated captive expense was $65,000 plus consulting. So let's walk through the cash flows and the relationships of the parties. The first, premium. The $1 million in premium is remitted through this customized policy issued by Sunstone into the individual captive that's arranged for this particular customer. If you recall, Sunstone is, again, a Delaware Series LLC captive, and it's not a group captive. It creates legally separate entities for each client, much like a pension administrator would with each of their customers. Within Sunstone, each of these individual captives can make an 831B election. So as the premium hits the policy, it's split between expenses of $65,000 and funds available for claims of $935,000. John mentioned earlier the discussion of fees for you, the agent or broker or consultant. The options are clearly to take that $65,000 and gross it up for your fee, or run a fee outside the $1 million in premium, or again using this structure to create the wedge to get a bigger slice of the overall P&C business from that particular customer based on the value being provided. So as we establish a series or a separate account, if you will, within Sunstone for this particular captive, we take the $935,000 and have that held in that series, that SBU, invested for the purposes of gaining investment income. And losses are then reimbursed out of that $935,000 for premium as they come due. They're reimbursed to the insured, who is the responsibility of adjusting and handling the claim with their vendors, and then having that claim payment reimbursed by the captive. Underwriting profit, again, within the Sunstone SBU with an 831B election is deferred from income tax until there's a distribution. The owner has decided that the captive will be owned by the trust that's part of their estate plan. That trust provides the initial capital for forming that SBU, and then distributions from that SBU are treated as qualified dividends to the beneficiary, again subject to 15% tax currently. So let's walk through the financials. And as John mentioned earlier, all of these arrangements are really focused on multi-year strategic planning, because if you view insurance on a loss-sensitive or self-insured perspective in 12-month increments, you miss really the substantial tail exposures that come to be crystallized in future years. So in this case, if the insured does nothing and self-insures, they can accrue $1 million a year or $5 million over 5 for those exposures. They wouldn't incur any captive expenses. They would have payments of losses during that period of time, and we've illustrated a $400,000 payment of claims. But the reality is that accrual is not tax efficient. So the amount after paid claims would be subject to income tax. This C corporation pays 35% tax, so the cash balance of $2.9 million is now available to address future claims or operating of the business. We're going to earn interest on that, $90,000. We're going to pay taxes on the interest. So at the end of the day, the business itself has $3 million of assets for future claims or for distribution to the shareholder. If there's a distribution through the arrangement where there's no captive, that's still subject to qualified dividend tax to the owners of the C Corp. $2.59 million is what's left over after tax. And if the shareholders wanted to gift those funds to the next generation, another 50% comes off the top. So at the end of the day, the next generation gets $1.295 million, or 26% of the original accrual of $5 million. What if we had an 831B captive and we paid $1 million a year? And we had the frictional expenses of the captive over that 5-year period of $325,000, a difference up on the top line, an expense difference that we as consultants and brokers have a challenge passing on. We focus so laser focused on expenses that sometimes we need to take a step back and see what is that expense giving us in terms of value to the business. Because it's an insurance company and because this particular customer meets the guidance for risk distribution, they were able to take a deduction for that premium. So there is no tax expense on that $5 million of contributions towards the captive. So after captive expenses and paid claims, we have $4.275 million of assets in the captive earning investment income at a higher dollar amount due to higher funds. But the 831B captive still pays tax on investment income. So your net result is you've accumulated $4.35 million of assets towards these self-insured obligations within the 831B captive. If you decide at the time to commute and close out the captive and make a distribution, obviously those would be subject to tax at the qualified dividend rate of 15%. So the shareholders receive $3.699 million. So if you cut it off there, from an efficiency standpoint, we've paid captive expenses. We've also paid the same level of losses. And at the end of the day, we still have $1 million more for the owners of the business. This particular owner was focused on gifting funds to his kids. And so from a distribution standpoint, this distribution would not go back to the owners of the business. It would go back to the owners of the trust and be subject to no no gift tax on the way through. So the net effect is we have $3.699 million of assets passing on to the next generation, or 74% of the total. Obviously, these totals will fluctuate based on the loss activity of the captive, but a fairly significant end result for a modest amount of upfront frictional costs. We talk about the insurance purpose. The litigation expenses associated with this particular business were extremely volatile. They not only hit or could hit at an inopportune time. The reality is, with these types of expenses, you really never know how deep you're going to go until you come out the other side with a settlement or with a judgment or a dismissal. So the tax-deferred accumulation of assets can provide quick access to capital, insurance proceeds, if you will, to meet those risk management objectives. So in 5 years, net of claims that were already reimbursed and captive expenses, the Sunstone SBU with this 831B election has accumulated nearly $4.4 million of assets for this business for risk management purposes. As John mentioned, having those assets available to provide letters of credit for primary deductible plans, reimbursing deductible losses under other large deductible or self-insured exposures is another sort of adjunct or build-out for the 831B solution. So where do we go next, and why should you spend the time helping your insureds and prospects determine whether an 831B works for them? Well, like all of our alternative solutions, Keystone's 831B approach will differentiate you from the competing noise in this 831B space. You own the idea, and you are integral to the insurance purpose that creates the solid foundation for this delivery. These programs are incredibly sticky. They often outlast the best traditional insurance company relationship you could bring to a customer. And the owner is empowered. They're part of the insurance process, and that elevates your status as a trusted advisor. Making 831Bs easy. Let's not overthink this. How do we get started? Quick call to Keystone. Give us a call with your idea or opportunity, and we can very quickly help you qualify that to see if it makes sense to pursue an 831B product. If so, we'll follow with a request for some preliminary information. Most recent insurance submission you have. Give us a feel for claim activity. Current financial statements and corporate organizational chart allow us to look deeper into the company to see if there's some value that we can unlock and if they have a good formula for premium deductibility. And your help in identifying uninsured or underinsured risks and exposures that you're concerned about that you may not have the attention of the buyer on because coverage is either unavailable or inappropriately priced, shall we say. So at that point, we'll take it from there. We'll work with you and the insured on the education, feasibility, implementation, and service of that 831B opportunity. So in terms of making calls, for ease, we've included our contact information at the end. And this concludes the content portion. What we'd like to do now is open it up to question and answers. And again, you have the ability to ask questions by typing them in to the webinar toolbar. And we'll get to as many as we can during this period. Okay, first question. Does an 831B captive make sense if qualified dividends and capital gains go away? The initial reaction to that would be absolutely. It still makes sense because if you think about the 831B captive, its primary purpose first has a risk management element to it. And the ability for an insured to look at a a structure where they can take a premium deduction, whether or not the captive has the 831B election, or whether the taxation of captive proceeds are differed from where they are currently. The captive insurance company has the ability to deduct reserves from its income by its very nature as an insurance company. So from a strategic plan perspective, the benefits of a small insurance company, an 831B or a captive solution, are not going to hinge on whether the tax rate for the distribution changes from a qualified dividend of 15 to ordinary income or not. Because again, the insurance and strategic purpose will outweigh those benefits for the business. Is it nice? Is it a nice to have? Yes. Is it an absolute? Probably not.
Question, is there a point in time when the captive structure becomes too profitable? How is that dealt with? Well, there certainly is a point in time at which initial expected losses for the exposures you're going to be funding in the captive change. Obviously, if you go a period of time without significant loss activity, that's going to affect the actuarial funding on the front end. And so a fair amount of time is spent each year doing the actuarial work to ensure that if the funding numbers begin to get too small, that additional exposures are underwritten into the captive. And the benefit of deferral in the 831B model kind of hits on the problem that a lot of non-831B structures have to deal with profitability or taxation before a distribution is ready to be made. We don't deal with that with the 831B because the captive itself pays no tax on underwriting profit.
Can an 831B captive be used as excess coverage to or over a first dollar professional liability policy? The answer to that is absolutely. Think of the 831B captive as a private insurance company. So if you were looking to build limits that were above a primary layer or a primary self-insured piece, then you could look at putting the captive in that position, recognizing that the captive will only be able to fund claims to the extent of its assets. And as you get higher and higher into the excess positions, the amount of premium that you will be able to drive into that captive to create the capacity for losses is going to be small. Reality is, if the exposure is small too, you begin to accumulate those assets over multiple years and the ability to use those to fund a claim should it get into the excess.
Can you break up captive and potential losses with different risks? If so, how many different risks can we include? The answer is yes. You can put a number of different risks into one 831B captive. In fact, it's fairly common. The policies that are manuscripted out of the captives for most of our 831Bs are what we would call difference in conditions policies that lean heavily towards the exposures that have been contemplated during formation. So if the exposure is a product liability exposure, product liability will be highlighted in that DIC policy, but there might be other exposures that are included as well. So we have manuscripted policies that will include everything from business income to flood and quake to cyber liability, and the captive can be tapped in the event of any of those losses.
There's a number of questions centered on third-party risk in the case study example. In the particular case that we were reviewing, the operating entity had in excess of 12 separate sources of risk for risk distribution within their own organizational chart. So from a structure standpoint, this 831B captive could be designed, and with the blessing of the insured's tax advisors, they felt that they were in the safe harbor for risk distribution based on their number of independent subsidiaries paying premium to the 831B captive. So there wasn't a separate need for a risk pool, which you hear a lot of when you hear 831B captives in that particular case, and there was no upcharge for that pool required in order for that 831B to be effective. Pools are very effective at bringing in third-party risk to insureds that can't find that within their organizational chart or can't offer certain types of coverages into their captive that would be considered third-party risk along the lines of a warranty or along the lines of bringing in minority interest businesses to their captive. So we are bullish on a properly structured pool as a potential solution after all avenues have been exhausted to bringing risk distribution into that captive, and if so, the additional charges will be passed on.
Yeah, and I'll just expand on that because there's a couple other questions that deal with just clarity about risk sharing with other captives or other insureds. And in the early stages of the process that we would go through with you and your customer, we would look at the organizational structure of the business to determine whether or not risk sharing or risk distribution thresholds could be met simply through the organizational structure of the company. If the answer to that question is no, then phase two typically is to then work through a third-party risk pool so that this newly created 831B structure can share just enough risk to meet the IRS safe harbors statutes, yet still maintain all of the control of an independent captive structure, unlike a group captive.
One last thing on risk shifting and sharing. Can subsidiaries be owned 100% by the parent? The general answer to that is yes, but you have to look at how are those subsidiaries structured. As an example, if the subsidiaries are LLCs and the owner of that particular LLC there's only one owner and it's 100% owned by the owner at the top, then that would be disregarded from the count. It also must be a subsidiary and not the parent.
Question regarding quantifying the difference between a wholly owned captive versus a cell captive, or in Delaware, what's referred to as a series LLC structure. Typically, the differences come in a few forms. One is capitalization. In general, the capitalization requirements are higher in a wholly owned captive than they are in a generically termed rent-a-captive structure. In general, the annual operating costs are higher in a wholly owned captive than they are in a generically termed rent-a-captive, because in a rent-a-captive, the individual structures are sharing in certain costs, such as the annual audit or annual financials of the captive.
How can surplus in the captive be invested? A couple of things, and again, gets to the individual strategy of that particular risk. For example, if the company is building assets for a self-insured exposure and wants to provide a tax-efficient source to back letters of credit to a large deductible policy, then the investment options would be fairly limited for those assets restricted for the purposes of supporting letters of credit and paying current liabilities, such as current claims due and expenses. Absent that, the ability to tailor an investment portfolio that looks at the liquidity needs for current liabilities, the near-term needs for non-current liabilities that may come due over the next handful of years, and then the true capital and surplus beyond that point. You can come up with a graded investment strategy. One of the things that we like to do once the captive gets some legs to it from a profitability standpoint is to engage the insured and their investment advisors to come up with a plan that can be designed for the captive. And we can establish a custodial account and allow those funds to be invested by the insured at arm's length, obviously, within the captive.
Question, are these captives obligated to buy reinsurance? They're not obligated to buy reinsurance. The insured is entering into an insurance transaction. They are obligated to meet the common notions of insurance test as well as the risk transfer test. But they're not obligated to buy, the captive itself is not obligated to buy reinsurance. We do have captive structures where the captive is buying reinsurance above the funded layer that's being sent in as premium by the insured, but that's not necessary to have a proper captive structure.
Is there an annual minimum premium or minimum funding level for the captive? There's always a soft minimum because you're really kind of looking at does it make sense, A, for the business to part with a level of cash as a premium for the captive that will create enough of a benefit to cover the frictional costs. I mean, if we have, in our example, a $65,000 annual expense to run the captive, it may mean for an insured that they would have to have a minimum of $300,000 in premium to make that expense make sense for them. Another insured with the same parameters may say, that doesn't make sense to me unless I can come up with or legitimately fund $500,000 to $600,000 of premium. So it's a soft minimum really focused in on what again is the insurance purpose, what premium does that insurance purpose generate, and then is there a strategic purpose that can be folded in to make it worthwhile for the business to part with that cash, and then at the end, are there tax benefits that we can get? And if all of those answers all the way through the process are a go, it really doesn't matter to us if the premium's $200,000 or $1.2 million. It really kind of hits the other foundation elements first. Capitalization is, again, going to vary, as John mentioned. Within a single parent captive, it's more formulaic based on the percentages of the premiums and ultimate losses. Within the cell captive or our series captive within Delaware, it can be less than the formulaic version for the single parent captive.
There's a question regarding fees. Are Keystone's fees included in the captive admin costs in your example of $65,000 in expenses? In that example, the answer is yes. And as the captive manager, that cost would be borne in that expense load. The actual cost to set up and run a captive structure varies based on the complexity of the exposures that are being put into the captive, the actuarial work, which again is included in that cost, the policy design, as well as the claims activity in the captive. Other costs that would affect the ultimate kind of financials of the captive would include, for example, that third-party risk pool if it was necessary in the structure.
Sorry, I'm scanning the list here to see if we've missed any questions.
There's a question, is there a minimum requirement for claims activity in the 831B captive? And to us, that really goes back to the common notions of insurance tests, that a properly structured insurance company pays claims. And so while there is not a there's not a revenue ruling, or there is not a hard number in terms of the loss ratio that a properly structured captive should write to, we like claims in our captives. We like captives that are structured where we need to be replenishing carrier escrows. We need to be funding either legal work or third-party claims administrators. That helps to meet just the sniff test of these structures. And we want to make sure that in each of these, 5 years down the road, when somebody looks under the hood of these structures, they see a living insurance company. So we get just a little guarded when we see structures that are designed to run at 0% loss ratios. They concern us just a bit.
Great. Well, we very much appreciate everyone's time today. We've left our contact information up, and we've included it on the presentation. Several have asked for copies. We will get those right out to you. And we certainly appreciate your questions and your interest in Keystone Risk Partners' approach to 831B captives. Feel free to call us offline with any additional questions. We'll be happy to work with you and look forward to hearing from you. Thanks again.